Hello guys, welcome back. So Meta Platforms actually announced their earnings yesterday, and this was amid a day in which the whole stock market was actually up, and especially Nasdaq was up about 4% during that day. Now, this happened after the Fed announced another increase in interest rates, and the actual market had a nice reception of this one, and pretty much the vast majority of stocks moved higher. But Meta was announcing their earnings report yesterday, and actually it wasn't that good. And this is why you're looking at Meta is being down right now after hours, about almost 4.6%. Maybe 5 or so when the market opens. We'll see what's going to happen. Probably going to be around 160 or so, I'm assuming. But in this video, we're going to be taking a little bit of a closer look at what is going on with Meta, what kind of earnings report they announced, and generally speaking, just take a little bit of a look at the company here in terms of its financials as well with the new data that we have. Now, if you're new here, please remember to leave a like, that helps a ton, and subscribe if you're not a subscriber. And remember, you can always get access to the tool that I'm using here by becoming a patron. You can find the link in the description box below this video if you're interested. But let's take a look. Meta reports earnings, revenue miss, and forecasts second straight quarter of declining sales here. Now let's examine the finer details of what happened here. The more surprising thing was actually the weak forecast, as it is actually mentioned here, and a decline in year-over-year sales, which is the second consecutive one, actually the second consecutive quarter. So here's what the company did really: 2.46% versus 2.59% that was actually expected. So that's quite a steep decline here, compared to what was expected really. And in terms of revenue, 28.82 versus 28.94, another decline here, not too significant, but still there is a little bit of a decline here. And daily active users that are still higher actually here, which is obviously a good thing, but monthly active users a little bit less. So this kind of balances itself out pretty much. Now, we do know that Meta has actually lost a lot of its value lately, especially last year. You can kind of see it in the tool here. It's about 60% down from its one-year high of $384. So it has been completely annihilated during the recent market slump, really. And as you'll see here, Meta's CEO Mark Zuckerberg said on a call with analysts that the company will be reducing headcount over the next year. They're pretty much tightening, amidst the potential economic slowdown here. Now, revenue in the third quarter is projected to be in the range of 26 billion to 28.5 billion here, trailing the previous estimate, the 30.5 billion average analyst estimate here. So this is a projected decline that is between 2% and 11% from a year ago. This is a pretty steep decline in terms of guidance as well. Now, you could potentially kind of expect this kind of outcome based on what has been happening with the markets lately. A lot of companies are actually coming back with subpar results. You could kind of expect that potentially from Facebook as well in this current economic climate. Snapchat, for example, was another one that was completely annihilated. It was like down 25% or so. Most companies have actually had subpar results again. Now, you will see here, of course, that the company is kind of struggling a little bit to monetize lately. It's what you're seeing here. And the continued growth of short video app TikTok seems to be getting a little bit of a market share from the company. Now, I'm not really feeling too worried about TikTok. It's a little bit of a different platform, really. I feel like Facebook is a much more prime player here, and they are mostly geared towards groups of people that are sharing similar interests. So I feel it's actually easier for Facebook to monetize, really, to advertise, and it seems like it's still going to be a very important piece of the worldwide business advertising, really. Now, they did say that their headcount increased 32% from a year earlier here, so they are still adding quite a few people here in terms of their employees. I'm assuming this has a lot to do with the metaverse that they are creating. And you will see that a hefty amount of spending is going into Meta's Reality Labs unit, understandably. Now, we did have some videos about Meta that were interesting, and people seem to like that a lot, the metaverse. Now, myself, I'm getting a little bit dizzy out of this kind of thing, but if people actually do like that and they are into the metaverse and the VR plays, that's going to be a fantastic addition for the company, and they are spending a ton of money here for making this thing work. And if that does work, it's gonna be fascinating and amazing for the company to add to their bottom line, really, and it can be a massive game changer for them. And it's a potentially interesting opportunity right now to maybe add to a portfolio, because if we're looking at a company that's going to be achieving great growth through the years, of course, after this current situation ends with the markets, then we may be, we may be seeing them being able to monetize the metaverse very nicely over the years. And this actually today may be one of the most prime opportunities to buy the stock, just because it's having some great financials here. As you'll see, and we have talked about it in the past, right now the company's P ratio and price to free cash flow is very low, at 13 and almost 14, a little bit more, 14, about 14 and 12 in terms of the price to earnings ratio, right, just right now, and the price to free cash flow ratio. It's actually in insane lows over here, as you'll see in the charts. It actually used to be near 20 at some point. So it's getting down and down and down, and outstanding shares are also going down because the company is buying back shares. And they will be buying back even more shares. They have already announced that. So this is another very, very interesting thing. And of course, the company has been growing their revenue, their net income, the free cash flow here, the total equity, everything has been growing for the company. Now, they are struggling a little bit right now in terms of the revenue growth, is what we already examined. But overall, they have been growing nicely through the years. And some quarters that are a little bit negative, or the company is not growing as much, is not a big deal, really. They will happen, especially when we're talking about the current stock market situation, where a lot of stocks are actually down and the whole economy is actually struggling. But we do care about buying the company when it's actually at a great price, and we're buying a great company. So this is what we want to be doing, even if they are not doing as well right now, because in the long run is actually what we should care about for the most part. Now, the margins of the company are still rather elevated here. They're sitting at 28% here, and returns are at about 20 to 26%, as you'll see here, in terms of return on equity as well. So the company is doing rather well in terms of actually returning some net income here in terms of the margin compared to the revenue that they are generating. So these things are looking rather nice for the company. But let's take a little bit of a closer look at the financials first, which will tell us a story of a company that has been growing dramatically from 40 billion to 118 billion. This is more than 4-time increase of the, actually no, more than 3-time increase. Actually a little bit more actually than a 3-time increase. And it's fantastic. I mean, the company has been growing the revenue at a fantastic pace, and even if they have some years that the revenue growth is going to be a little bit less, we are still looking at a company that has fantastic growth opportunities, and especially if the metaverse works out, of course. And a net income of 16 billion to 40 billion here. This is another 3-fold increase almost. Another great thing to see here. The company is growing at an insane pace. And in terms of their balance sheet, you will notice that they have about 40 billion in terms of total liabilities, and a total equity of 125 billion. So this kind of total liabilities is very little compared to the total equity that the company generates. And what's even more important here, you can see this total liability number here, 40 billion. And if you take a look at their cash flow, you will see that the cash flow that they generated last year pretty much is 40 billion. So basically, it would just take them last year's free cash flow to pay back all their total liabilities. Absolutely insane here. And in terms of what the company is doing from in operating activities cash flow, you will see it's also been increasing more than 2 times here, as 58 billion right now. And of course, the company is investing a little bit, and there's going to be some spending, I'm pretty sure, some extra spending eventually in terms of capital expenditures. And take a look at this financing here. The company is buying back shares like absolute mad maniacs here. Take a look at this one, 44 billion, almost 45, that was added to financing activities here. And the company is buying back shares insanely, at an insane pace here, which I love to see as a stockholder that I am right now. And the free cash flow that the company has, you will see again, 40 billion is what they are at. Now, the next thing that I want to take a little bit of a look at, and I have checked it also in in some of the previous videos, is insider trades and what is going on here with the company. Now, you will see that the company's insider trades are looking normal, very normal here. There are some sales here, but they are mostly awards. These are restricted stock units. This is very common actually for employees and officers to be getting, directors in this case, to be getting some stock and selling it immediately because it's part of their compensation. So it's nothing too worrisome here. It's pretty much restricted stock units for the most part, and activity looks fairly normal pretty much overall. So this is another nice thing to see here for the company. And the other thing that I want to see, of course, is the stock evaluation tool and see what kind of price to pay for the company right now. And we do know that the company is going to be struggling a little bit in terms of revenue growth potentially, at least for the next few quarters. So let's just try to go a little bit low here. Let's go 8, 10, and 12 in terms of the revenue growth, which is much, much lower than what they have been doing. And this may actually not be the case. It may be even higher because this is a 5-year tool. It's a 5-year projection here. And so, yeah, you may be having maybe 1 year, maybe 2 years even of suppressed revenue growth, but then it may actually skyrocket again. So these kind of projections, I think they are very fair. And in terms of the net income margin, I can still go rather low here compared to what they have been doing pretty much overall. Let's just go maybe 28, 30, and 32 here, a little bit lower than their overall averages. And free cash flow margin, it's typically at about 100%, which is very nice to see. So I'm gonna go 90, 100, and just 110 here in between. An annual return of 13%. And with these fairly conservative projections, let's see what we're getting out of the stock tool. We're sitting at a low of 205, medium of 266, and a high of 338 here. And the current price is going to be sitting at about $161, I believe, when the market opens. Now, of course, you can always be trying even less aggressive estimates here and see what we're getting, and we can try some of those. Just see what we're getting if we change some of our low estimates, for example, here. So let's just try to go maybe, let's say 5% here. So what we're getting out of 5% in terms of revenue growth. Then I think a margin I'm gonna keep at 28%. See what we're getting out of this one. Now with this one, we're sitting at about $181, and it's still in the green. So even if the company goes 5% in terms of revenue growth and 28% in terms of net income margin, with about the same free cash flow margin and slightly less, we are sitting at a green price still, at a price that is definitely a buy right now. So overall, this is a company that I would definitely buy, and I have already actually bought it, and I think it's a great opportunity, even though it's still down and it's probably getting at about 160. It looks like when the market opens again, we're probably going to see it near 160 or so, which I frankly think that is absolutely insane for a company of this sort, regardless of the recent quarters that have been a little bit subpar. Overall, the company is fantastic and has a ton of money, really. It's practically printing them. So thanks for watching. Please remember to leave a like again, and I will see you in the very next video. Tons of earnings upcoming, so I will be making quite a few videos in the next few days. So again, thanks for watching, and I'll see you soon, guys. Bye-bye.